question. So a security market index represents what, right? ABC. Risk of security market? No, not at all, right? Security market as a whole? Not exactly. Market segment, security market segment or asset class? Yes, C is the answer, right? C, index is not equal to only risk, right? That eliminates our option A. Index is not always entire market, that eliminates B also. Index is a representation of any defined segment, right? This is a definition-based question, very common in CFA, right? So once we have done this, we move ahead. Then next we go to practice question number 2. 1 month after inception, the price return version and total return version of a single index consists of identical security and weights will be equal if market prices have not changed. No, right? Not in this case, right? Capital gains are offset by capital losses. No, not exactly. Securities do not pay dividend interest, right? So if income is zero, right? Both returns are kind of same, right? Because price return versus total return, it basically the difference comes out in income, right? So golden rule is that total return is equal to price return plus income, right? So total return equal to price return. That's your income. Income basically is dividends and cash flows, right? So income is equal to zero, right? To meet, kind of make TR equal to PR, right? So keep that in mind. Please understand total return includes income. Income can be dividends, interest. Price return kind of ignores it. So if no dividends, no interest, then both indexes move identically. The takeaways, very important for exam, index is equal to portfolio representation, two returns, price return, total return, more realistic, always use geometric compounding. Index construction depends on market definition, your selection, your weighing, your rebalancing. If no income, price return is equal to total return. Okay. So keep that in mind very, very critically. Right. Going on. Let me move to the next question. Next question is your question number 3. The value of a price return index and total index consist of identical equal weighted dividend paying equities. Will be equal when, right? See, they will be equal only at inception. Why only at inception? Because see, the core concept is that difference between the two is dividends or the income. Price return ignores dividend. Total return included dividend. So key insight is at inception, no time has passed, so no dividends received yet. So both start at the same base value, so only at inception. Why not others? Because if you look at your rebalancing, right? So rebalancing just adjusts your weight, does not remove dividend impact. If you look at reconstitution, changes your stock, still doesn't eliminate your dividend. Only situation there matches when no income has accumulated. So the point here is exactly at inception, both indexes start equal. After that, total return is greater than price return if dividend exists. Very, very important. Okay. So this is done. Then we go into your practice question number 4. Security and market indexes are what? Right, constructed and changed like a portfolio of securities? Yes, true, because security market indexes has weights, right? Has rebalancing, has your selection rules, right? When you look at option B, simple interchangeable tools for measuring the returns of different asset classes. No, it's not an interchangeable tool. Equity index is not equal to bond index. Different construction, different results. Security market index are valued on a regular basis using the actual market price of the constant securities. Yes, it uses your market price, so that is good. But definition is much broader, right? I'm not saying this is totally wrong. They do the thing, but which is more important is this one, constructed and managed like a portfolio security, right? So they're valued, using prices, but please keep in mind, right? The more accurate is this one. Index is equal to manage your portfolio, not just a number. Also keep in mind that it reinforces the concept that index behave like a portfolio manager's construct. It should keep in mind, right? Okay, then we get into next part, which is your practice question number 5. When creating a security market index provider must first determine what? Target market, appropriate weighing method, or number of constant securities, right? So you need to think logically before anything. You must decide what you are kind of tracking. So the most important is that you need to understand your target market first, right? So that is very, very important. Then it comes the security selection, then comes the weighing method, then comes the rebalancing, right? So first thing, right? Because the question is asking first, you need to understand target, right? First, keep the target market. That's the first thing. The second is security selection. Third is weighing method. Fourth is rebalancing, right? So first one is your target market, right? Remember that. Okay. So please keep that in mind. Target market defines your investment universe. Without defining a market, nothing else makes sense. Now we move to the next part, which is calculation-based question. Analyst gathers the following information for an equal weighted index comprised of assets Abel, Baker, and Charlie. ABC equal weighted index is given, right? So what we understand is Abel is beginning price 10, end price 12, 20, 19, 30, 30, right? And dividend is 0.75, 1, and 2. So this is the price return. You kind of ignore the dividends, right? So step one is you need to calculate individual returns, right? Individual returns, so which will be for Able 12 minus 10 divided by 10, which is 20%. For Baker, which is 19 minus 20 divided by 20 minus 5%. Charlie, 30 minus 30 divided by 30, 0%. Right, so equal weighted index, what do we do? Right, give the weight equally to each one of them. Right, so equal index is the simple average of the return, right? Equal weights, right? Equal weighted index, simple average, right? So 20 minus 5 plus 0 divided by 3, which is 15 by 3, gives me 5. Simple average, right? Okay, keep this in mind, right? Price return is equal to weighted average equal weights here, right? Please remember, price return is basically your weighted average. But why did we take it average here? Because weighted average means we could have done this also, right? 20 into 1 by 3 minus 5 into 1 by 3, 0 into 1 by 3, and then found the value. But again, this was same now. 1 by 3, 20 minus 5 plus 0, right? So it is like 15 by 3 is equal to 5. Okay. Same data, right? The next question is exactly same data, but we are asked your total return now. Same data, we are asked total return. Total return of the index. What happens here is that now we'll include a dividend also. So when we include the dividend, that calculation we should be able to do. So to save our time, we'll go to the calculation. So you can see here, same thing, 12 minus 10 plus 0.75, right? 90 minus 20 plus 1, 30 minus 30 plus 2, right? So now here 27.50, 6.7, right? Equal weighted, same thing, get 11.4, right? So again, the concept is same, right? I'm not saying concept is difficult, right? But you have to add the total return, you have to add the dividend, right? So this is to be done. Then we move to your question number 8, right? The question number 8, we are looking at after both your uh, price return and total return, we have again got a question of price return, which is basically uh, analysts gather the following information with price weighted index, ABCDF, GHI, and price return of the index has to be calculated, right? So when we try to uh, calculate the price return, right? So ABC 25, 27, 35, 25, 15, 16, right? And when we are trying to calculate the price, right? For each we have to calculate, right? And then this question doesn't exactly say, right, that it is a equal weighted thing, right? It's a price weighted index, right? It doesn't actually say that it's a equal weighted thing. So how do we do it, right? So what will we do here? If we go to see here, what is done here? The price return of the price weighted index is the percentage in the price of index, right? So what is being done here? You add the full thing. You add the full thing. Ultimately, 75 and your 68. Right, so 68 minus 75 divided by 75 is equal to minus 9.3%, right? So higher price stocks have more influence, very important to understand. Also, it is very important to understand that you just sum the prices, compute the percentage change uh, for your price return of the price weighted index, right? So simple. Now, there is another question in this chapter, right? The question number now. Right? Here we have analysts gather the following information for a market cap weighted index. That was your. So you need to know the small differences, right? The previous question was price return for the price weighted index, right? So simply we added up and found out. Here we are looking for price return for a market cap index. Price return for the market cap index, right? So what is the difference here? See, when you look at your market cap index, right? So you have to understand the multiplication with your, you have to find the market cap, right? Which is this shares multiplied by your share price, right? So that is what you need to find out, right? So you have to find the beginning market value. You have to find the ending market value. Beginning market value and ending market value. Ending market value, how do you find out? Ending market value, you find out beginning, you multiply this. Ending, you multiply this with this, right? And right, beginning with ending, right? So then we calculate, right? So basically, idea here is that it's a market cap thing. So it will not come out just by adding, right? You have to multiply and then get the value, right? So beginning market value, just found out multiplication, this value, ending market value, this value. So 48 to 50,000 minus your 53, 750,000 divided by 53, 750,000, right? So again, small things. Figure out how these are calculated. If you calculate this, you saw B is the correct answer, right? Then we get into next question. Next question is, when you get into next question, which is question number 10. Analyst gives the following information for a market cap weighted index. Total return. Total return, again, you do the same thing, but you add the dividend also, right? So same logic, but don't forget to multiply stocks with dividend because dividend is per stock, right? So total dividend also, right? So this is beginning market value, this is ending market value, total dividend also, right? Now total dividend will go where, right? Total dividend will go in the, total dividend will go where? Beginning market value or ending market value? That will go in the, what you say, where it will go, right? So total value at the beginning is given this, right? Ending value is a combination of this, right? So you have 48 to 50 plus your 2625 minus beginning value 53 750 divided by your 53 750, right? That is your total return as this, right? So ending value plus dividend will be the value, right? Because dividend is coming later, right? So that is, keep that in mind, right? So again, this you have to do, guys. Okay, so when we carried out the price return in the previous question, it was minus 10.23. When we carried out the market or total return, right? You added the dividend, it is minus 5.35. So dividend kind of reduces the losses. Then we understand from the previous question is that income kind of questions your dividend, right? So we need to understand. When creating a security market index, the target market determines the investment universe. Your is usually a broad defined asset class, determines the number of securities to be included in the index. Security market index, the target market determines the your investment universe, right? Why? Because target market define what can be included, right? So universe always come first, right? Remember that. Okay, small things you have to read carefully. Then we go to your practice question number 12. An analyst gathers the following data for the price weighted index, right? You have security ABC, beginning of period 2050 26, share outstanding, end of period, shares are given again. The price return for the index. Now we are asked price return for the index. Beginning price is given 20, ending 22, 50, 48, 26, 30. You have to calculate the return. How will you calculate the return? Here outstanding are same. In this case also this. End of period also this. What do we use in the price return? Share outstanding given, but kind of you can ignore it, right? You don't need to bother too much because the price weighted index depends only on the prices, right? So what do we do here? Uh, the important part is that when we take the price weighted kind of thing, right? You focus only on the prices, right? So how do we calculate here? Any logic? What do we do here? Direct. The sum of prices at the beginning of period was 96, sum of price end of period was 100 by 96 minus 1, right? That's straightforward, right? 100 by 96 minus 1. So easy, but so confusing because, and that's why I went directly to the answer, right? A lot of people, when trying to price return, they will say multiply, etc. Ignore that, right? 20, 50, 26, right? So this is beginning value, this is ending value, 48 and 100. So it is ending minus your beginning divided by beginning. So that's straightforward, right? 100 by 96 minus 1. Okay, very straightforward, very simple. Okay, then we get into the next part, which is practice question. Before we get into practice question, please understand equal weighing. You are effectively doing, you are selling your winners, buying your losers. That's a contrarian rebalancing kind of thing. Whenever you think of your what you say, a framework for this, right? Please ask what determines your weight. If the price determines your weight, it's price weighted. If shares into price determines your weight, market cap equal means equal. Fundamentals, fundamental. Price, the bias is arbitrary. Market cap, it is momentum bias. Equal, small cap bias, fundamental value bias, right? So there is a bias, right? So price weighted index are very simple but flawed. Market cap indices are realistic but momentum driven. Equal weight indexes are diversified but costly. Your fundamental indexes try to correct the valuation distortion, right? So remember that, right? Fundamental are fundamental, right? And equal weighing are kind of contrarian rebalancing, but it is selling your winner, buying your losers, right? So contrarian investing kind of rebalancing kind of thing, right? So now going to this question, your analyst gathers the following data. Now we are looking for return on the value weighted index, right? So again, if you're trying to get the return, so what we'll do? It is return is what? End market value divided by beginning market value minus 1, right? What is the beginning market value? First you multiply, right? 20 into 300, 50 into 300, 26 into 200, right? So once you multiply, you get 73,000. This whole thing, right? This is your beginning market value. Then we look at ending market value. We are looking at, okay, and same thing, 22 into 300, right? 48 into 300, 30 into 2000, right? You do it, you get 81,000, right? That thing, and basically your 81 divided by 73 minus 1 is equal to your 10.96, which is 11%, right? So this is approximately B. Right. The key idea here is market cap index is just track your total portfolio value change. No need to calculate your individual returns, right? So that's pretty straightforward, right? Then we get into your next part, question number 14. Analysts gather the following data for an equally weighted index. We have ABC. Again, see, when you are doing for equally weighted index, right? Return is average of your return here is your average of your individual stock returns. You have to remember this thing, guys. Please understand whatever I am writing, you have to understand and follow it, right? So we are going from 20 to 22 in this part, right? So it is what is it's a 10% return, right? We are going from 50 to 48, right? It's minus 4% return, right? We are going from 26 to 30, which is your 15.38% return, right? Now, what will happen is just do it, right? 10 minus 4 plus your 15.38 divided by 3 is 7.1. So answer is 7C, right? So equal weighted, ignore your shades completely. Don't bother about that. Very, very simple, right? So you have to remember these things, how each thing is done, guys. This is what the whole idea here is. Question number 15, which of the following index weighing method requires an adjustment to divisor after a stock split? Right, we understand that is your price weighted, right? Price weighted is affected by your price change, so needs your adjustment. Market cap, price goes down, share goes up, no chance changes. Fundamental unaffected, right? So remember that only price weighted index needs your divisor adjustment, right? So remember that. Okay, this is done. Then we go to question number 16. If the price return of an equal weighted index exceeds that of a market capitalization weighted index comprised of the same security, the most likely capitalization is what? So the idea is that, see, what is important to understand is that equal weight, right? Equal weight kind of your outperforms, right? Equal weight outperforms. Why? Because see, if the price return for equal weight index exceeds that of a market cap index composed of same security, the most likely explanation is equal weight. There is a more exposure to your small cap, right? So equal weight, I told you, right? It's like it's a different thing. Equal weight is greater than market cap, right? If equal weight is doing better than your market cap or market weight, small caps must be doing better. Because market cap greater than equal weight means momentum. Large caps are doing better. Equal weight doing better than market cap is opposite, right? So equal weight had a hidden SMB factor, right? Your former French model, your small minus big factor exposure, right? Which will come ahead, right? So remember this point. So again, very interesting question. You have to remember this. Next question is a float adjusted market capitalization with index each of its constituent security by its price and so float adjusted weights based on price and what? So weight is equal to price into your free float shares, right? So free float is basically shares available to public, right? Excluding your promoters, government, strategic holders, right? So answer is C. Shares available to the investing public, right? C. Okay, this is what real world indices actually use, right? So market cap return, total value change, equal weight return, average return, divisor adjustment, only your price weighted, equal, greater than market cap, small cap outperform, float adjusted, use your tradable shares, right? So remember that point, right? So again, right, what we need to figure out here is that price weighted is equal to price bias, market cap is equal to size bias, right? Equal weight is small cap tilt, right? Float adjusted is kind of investable reality, right? So price weighted, price bias, market cap, size bias, momentum bias, equal weight, small cap tilt. We're looking at investable reality for the free float, right? Float adjusted. Okay. So this is done. Then we get into next question. Which of the following index weighing method is most likely subject to a value tilt? Value tilt is what? Value tilt is what? Fundamental investing, right? A value tilt means the index tend to give relatively more weight to stocks that look cheap on fundamental, such as earnings, your dividend, your cash flow, book value, etc. So it's not your equal weighing. Equal weighing has a small cap tilt. it's your fundamental weighing, because here things are based on fundamental rather than your market prices. It naturally tends to overweight stock with stronger value characteristic. Market cap weighing is generally for momentum or overvaluation bias, not a value tilt, right? So answer is B. For example, remember fundamental weighing is value tilt, equal weighing is small cap tilt, market cap weighing is momentum like tilt, which you need to remember. Okay. So keep that in mind, very, very clear, right? So fundamental weighing indexes tend to have a value tilt, right? This is one of the major distinguishing feature, right? Okay. All right. Mm, fundamental weighing index tend to have a value tilt. This is one of the major distinguishing features, right? So then we get into question number 9, right? Rebalancing an index is the process of periodically adjusting the constituents, right? Which of the option is correct? Securities ways to optimize investment performance. No, there is no investment performance. Index providers are not trying to actively maximize return here. They're trying to maintain the design of the index, right? Uh, Securities to maintain consistent with the target market. That is more like a reconstitution, because that means changing which securities are included. That's not the aim also. Adjust securities weights to maintain consistency with your weighing method. This is exactly what rebalancing is. So we are looking at C, option C, right? So key idea is the question says weights, think rebalancing, member securities included, think your reconstitution, right? Very, very important. Rebalancing means you're adjusting the weights of the current constituents so they remain aligned with the your intended weighing scheme, right? Then we get into the next question, right? Question number 20. Which of the following index weighing method require the most frequent rebalancing? Again, out of price, equal and market capitalization weighting. Equal weighing gives stock the same target weight, but once your price start moving, some stocks go up more, some go down more, weights stop being equal. So the index must be rebalanced frequently to bring weights back to equal compared to others, right? Your price weighted mostly changes automatically with the price. Market cap weighted automatically changes as market cap changes. Equal weighted does not kind of self correct, right? So the key idea here is that equal weighted index requires the most kind of maintenance, right? Remember that as price changes, because initially equal weights drift apart. So equal weight indices the most rebalancing, right? Then we have done this question also. Then we go to question number 21. So reconstitution of security market index reduces what? Right? Does it reduce the portfolio turnover? No, it doesn't reduce the portfolio turnover, right? Reconstitution usually increases turnover because securities are being added and removed, right? So need for rebalancing, right? Reducing need for rebalancing? No, again, no. Rebalancing is a separate process related to weights, not your constant replacement. Then look at the likelihood the index includes securities that are not representative of the target market. Yes, that is exactly the purpose of your reconstitution. So over time, some companies no longer fit the index rules. Reconstitution helps clean up the index, so it still represents the intended market, right? So reconstitution help you ensure the index remain representative of the target market by removing firms that no longer qualify and adding kind of firms quality, kind of adding firms that do and removing firms that no longer kind of qualify, right? So rebalancing, you have same securities, adjust your base, mainly important for equal weight index, reconstitution, change security index, maintain representation of target market, can create price pressure on addition and deletion. Overall, the hack here is that rebalancing weights, reconstitution members, uh, just understand that, right? So security market index are used as what? Right, measures of investment returns, not precisely, right? So that is very, very important. So we were doing the security market indexes are used as, right? Security market indexes are used as what? Are they used as your measurement of investment returns? No, not precisely, because index shows your market return, not your individual investment return, right? So not the investment return. Are proxies to measure your unsystematic risk? Again, no. Unsystematic risk is diversified away, so not proxies for that. Proxies for specific asset class and asset allocation model, yes, right. This is it. Index is a proxy for asset class. Very, very important. Right? Proxy for. Right. Then you go ahead. Uses of your market index do not include serving as a uses of market includes market indexes. Uses of market indexes do not include serving as a what? Measure of systematic risk. Wrong usage, right? Wrong usage. Right. Okay, so again, since the question is asking confusing, right? Do not include. So that's a wrong usage, right? Because index measure your systematic risk, not your systemic risk. Now, this is very confusing. What's the difference between systematic and systemic? Systematic is your market risk. Systematic is your market risk. CAPM. Systemic is equal to financial system collapse risk. Please understand, market index do not include serving as a systemic risk, right? That's a wrong usage. Index measure systematic. Systematic is okay. Systemic is not good. Your basis for your new investment product, yes, ETFs and index funds. Benchmark for evaluating your portfolio performance, yes, right? So we are looking not. So A is answer. Very tricky question. Very tricky question. Systematic versus systemic is a big exam trap. It's a classic trick.